Disney, the entertainment powerhouse, has just unveiled its third quarter results, and they paint a concerning picture. For decades, the Walt Disney Company has stood as a global media and entertainment icon, captivating generations with beloved cartoon characters and timeless classics. However, these are challenging times for Disney, with its three major pillars, streaming, studio, and parks, struggling this year, resulting in staggering financial losses. Traditionally, Disney could rely on the resilience of its diverse portfolio, but in 2023, it's facing hurdles across the board. If you enjoy this video, please make sure to subscribe to the channel and leave a like below this video. KeyBank Capital Markets analyst Brandon Isbell expressed this during an interview, highlighting the company's broad range of challenges. Disney's retail sector, which once held iconic locations that captured the hearts of many, has mostly vanished. The move away from physical stores was driven by declining sales and foot traffic, which made maintaining these establishments financially unsustainable. Despite this shift, online sales haven't been a silver bullet. In fact, Disney's online revenue recently dipped by nearly 6%, a trend attributed to rising inflation. Adding to the turbulence is the downturn in Disney's streaming platform, Disney+. It lost over 10 million subscribers in 2023 and announced its third price hike in as many years, causing further subscriber erosion. Comment below what you think of Disney's current state. In August, Disney Plus had 146 million subscribers, down 7.4% from the previous quarter. Several factors, including COVID-19's impact, intense streaming competition, shifting consumer preferences, content saturation, and geopolitical challenges, have strained Disney's media empire. But many industry experts point to mismanagement as the core issue. Under former CEO Bob Chapek's leadership, the company invested nearly $30 billion in new projects and expansions, yet the returns remain elusive, with some investments lost due to attraction closures in 2022. While former CEO Bob Iger assumed control after Chapek's exit, shareholders are still waiting for substantial improvements. Disney is working hard to revitalize its box office returns, but some devoted fans believe there's been a saturation of content over the past decade, leading to a decline in quality and audience fatigue. Disney Studios in particular faces challenges, with costly productions struggling to find their place in the market. The company now leans heavily on its established franchises like Marvel and Star Wars, even as some longtime fans grow weary of these once-beloved properties. Marvel Studios and Lucasfilm, two of Disney's major subsidiaries, are grappling with mounting pressure as their films and TV shows struggle, leading to significant budget cuts and production cancellations this year. However, these issues only scratch the surface of Disney's challenges. Disney parks, which contribute 2/3 of the company's revenue, are experiencing declining popularity due to steep price increases. Even at Walt Disney World, the iconic US theme park, attendance has hit historic lows, even during the typically busy summer season. Soaring costs for tickets, hotels, food, drinks, and merchandise have placed a Disney vacation out of reach for many American families. Complaints about rising admission prices and the elimination of free perks have been widespread among parkgoers. Additionally, Disney faces challenges in its streaming and linear TV segments. Streaming subscriber growth has stalled, leading to losses in the direct-to-consumer segment, while the traditional TV division reported a 23% decline in profit to $1.89 billion. Disney is also exploring options for non-core media assets, including ABC, and is open to partnerships for ESPN. Disney's stock has taken a significant hit, trading at 9-year lows with a dramatic drop in June. Investors are growing increasingly skeptical about the company's ability to turn its fortunes around in the near future. Once an unrivaled giant in the media industry, Disney has struggled to connect with its audience in recent years. The company's board is actively seeking a new public relations representative after controversial remarks from CEO Bob Iger regarding ongoing actors and writers' strikes. Iger's comments, which were criticized as out of touch, led to backlash, with calls for better public relations. The company is now offering $330,000 to a new communications executive, aiming to enhance and protect its reputation. Disney's financial indicators are worrisome, as the company grapples with debt that ballooned to $54 billion during the pandemic. Efforts to cut $5.5 billion in costs have already resulted in 7,000 job cuts, reflecting the need for financial discipline during these challenging times. Disney's extensive debt burden has led to significant repercussions across its various divisions. Layoffs have affected executives at ESPN and ABC News Radio, while television shows on Freeform have been cancelled. Disney Plus has seen the removal of numerous shows, and the company has written down losses on its tax returns. Furthermore, Disney is now selling off its last radio station. One of the most notable consequences of Disney's financial struggles is the closure of the Star Wars-themed Galactic Star Cruiser attraction at the Epcot resort area. This closure was prompted by a miscalculation in how much customers were willing to spend on the experience. Despite the immense popularity of Star Wars, it appears that the high price point, with rates ranging from $4,800 to $5,999 for a couple or family, deterred potential visitors. Disney's transformation from a more affordable, middle-class friendly brand to a luxury brand catering to a wealthier clientele has been a significant shift. While this strategy may yield short-term gains from those willing to pay a premium for exclusivity, it raises questions about Disney's long-term sustainability. Relying on a smaller number of high-paying guests alone may not be enough to support a multi-billion-dollar company. The concern is that Disney's management may be overlooking the importance of accessibility and affordability, which have been integral to the company's success for decades. Pricing out the middle-class income group risks alienating a significant portion of its customer base. While Disney has never been considered cheap, it has traditionally been seen as an attainable and beloved destination for middle-class families. In essence, Disney's current approach appears to be a risky gamble, testing how much money can be extracted from wealthier Americans before the business reaches a critical tipping point. It remains to be seen how these strategic shifts will impact the company's long-term financial health and customer base. Please make sure to subscribe to our channel for more upcoming videos and leave us a like below this video. We appreciate all your support.